Hello, ladies and gentlemen. Good afternoon. Welcome to our today's webinar with the title Transfer Pricing Developments in Cyprus, brought to you by Taxand Cyprus, and of course by our guest speaker today from the OECD, Matt Andrew. Matt is a senior tax advisor for the OECD, leading the Tax Treaty, Transfer Pricing and Financial Transactions Division. Thank you very much, Matt, for joining us today in our webinar. Taxand Cyprus will be presenting the recent TP developments in Cyprus, providing an update on the transfer pricing financial transactions, focusing on intra-group loans and discussing the importance of transfer pricing substance. Matt will be discussing the OECD's ongoing work on digitalization, the unified approach and the recent guidance relating to transfer pricing implications of the COVID-19 pandemic. Some housekeeping notes for you. We would like to hear your questions. So don't forget, whenever you hear something that you have a question on, write it in that Q&A box you see on your screen. All your questions will be answered at the end of the session, after all the speakers will finish their presentations. The presentation today will be circulated to all of you immediately after the event. And the profiles of each one of the speakers are also in the presentation in the last slide. And if you have, in any case, any other question, you can send an email to our general email, taxand@taxand.com, and you will be directed to the appropriate contact immediately. For those of you who just joined, let me again welcome you to our today's webinar, Transfer Pricing Developments in Cyprus, and I will pass immediately without any delay to our guest speaker, Matt Andrew from the OECD, to kick off the webinar. Matt?
Good afternoon, everyone. My name is Matt Andrew, and as mentioned, I lead the OECD's Transfer Pricing, Tax Treaty and Financial Transactions Division. To set the scene for today's discussion, I will briefly outline and discuss two recent OECD reports and provide a brief outline of the key features of the Financial Transactions Transfer Pricing Guidelines, which was published in 2020, and also the COVID-19 Transfer Pricing Guidelines. As it relates to the unified approach and the project on digitalisation, I won't make any comments in relation to that as negotiations are ongoing, except to note that the blueprint for Pillar 1 and Pillar 2 were released in October 2020. We had the public consultation in relation to that in January 2021, where we received over 3,000 pages of input from discussants, which included business, NGOs, and academic commentators. And we have taken a lot of that material into the recent simplification process we're looking at in terms of Pillar 1. But let me turn to the next slide as it relates to financial transactions. So in terms of an introduction on the Financial Transactions Transfer Pricing Guidelines, let me just note a couple of points. The Financial Transactions Guideline has been long awaited and has been difficult to get agreement on. That is, in Working Party 6 and the inclusive framework, there were significant negotiations in terms of different aspects of the guidance. Countries have had very different positions on interest rate setting, guarantee fees, and also other aspects of the financial transactions guidance. The final guidelines were published in February 2020 and will be incorporated into the updated transfer pricing guidelines, which are expected out sometime in 2021. On intragroup loans, which is on the next slide, in general, the guidance notes a couple of points which you should keep in mind in relation to the setting of interest on intragroup loans, which includes consideration of both the lender's and the borrower's perspective. It cautions about the use of publicly available credit ratings, and it elaborates on the relevance of credit ratings. It considers the issue of credit ratings and the effect of group membership, and it considers the benefits that a multinational receives solely by virtue of a group affiliation as incidental and does not require any payment or comparability adjustment. Just a couple of points to note from that list. From the lender's perspective, or receiver, or how much to lend and on what terms, and will it involve a credit assessment. That credit assessment will include understanding the business itself as well as the purpose of the loan, how it is to be structured, and the source of its repayment, which may include the analysis of the borrower's cash flow forecasts and the strength of the borrower's balance sheet. From a borrower's perspective, it is important to consider the risks related to acceptance and use of the funds from the perspective of the recipient. And these risks will relate to the repayment of the amount transferred, the compensation expected for the use of that amount over time, and the compensation for other risks associated with the loan. On publicly available financial tools or methodologies, just one quick point from me. The credit rating methodology used in publicly available financial tools may differ, and sometimes actually differ significantly in certain respects from the credit rating methodologies applied by independent credit rating agencies to determine the official credit ratings, and the impact of any such differences should actually be carefully considered. And so I do note that as something which there is guidance in the financial transactions TP guidelines in relation to that. On cash pools, which is on the next slide, the financial transactions TP guidelines make some comments in relation to the issue of cash pooling. The cash pool leader generally performs coordination and agency functions, and therefore it does not assume the relevant risks, i.e. liquidity and credit risks. And this aspect is illustrated through some examples provided in the guidelines. And this could be formed, it also notes that this could be performed as part of a treasury function, and therefore a cost plus return could be expected and maybe not a margin return. And the benefit from a member from taking part in cash pool arrangement may go beyond mere enhanced interest rate. So such as it could also include quick access to liquidity, for example. On the next slide, just briefly on guarantees, and let me just make a couple of points here, as this will be elaborated on by the other speakers as well. There is a need to justify the guarantee as providing a benefit to the guaranteed party. That benefit could translate into enhanced borrowing terms or access to a larger amount of borrowing. The guidance acknowledges the possibility that the guaranteed party could obtain better borrowing conditions, even when the guarantor does not have a better credit rating. And so just by allowing the lender to have access to a wider pool of assets, and the guarantor must have financial capability to actually provide the guarantee. And there are 3 examples that illustrate this section of the guidance as well. And so I just wanted to make a couple of points in relation to financial transactions. There were other parts of the report as well, but in the interest of time, I just wanted to note what I consider to be probably some of the more common features which may impact the listeners of this call. Let me now turn to the next slide, where we have also provided guidance in relation to transfer pricing and the impact of COVID-19 as well. So we had support from the delegates of Working Party 6 and the FTA MAP Forum to draft the recently released transfer pricing guidance in COVID-19, which was released in December 2020. And so let me just take you through some key elements in relation to that. So I guess against the background of COVID-19 and its impact, businesses identified quite a number of issues and transfer pricing issues that they considered were important issues in terms of continuing to meet the transfer pricing guidelines and be compliant with transfer pricing requirements. And so those issues related to, for example, government support, comparability analyses, the treatment of losses, and the impact on advanced pricing agreements. And so it was considered by members of the OECD and the inclusive framework that some guidance should be provided in relation to and on top of the existing transfer pricing guidelines for the specific impacts of COVID-19 and its financial impact. So turning to the next slide. One area which was identified was the issue of the treatment of government assistance programs and the treatment and transfer pricing implications of, for example, government subsidies, government-backed loans, and furlough schemes. And so the unprecedented government intervention in many economies has created novel transfer pricing questions. For example, how furlough schemes, for example, or subsidies should be accounted for in an entity's cost base when applying the transactional net margin method, or if and how government-backed funding initiatives should be accounted for when benchmarking for intra-group financial transactions. And so the guidelines provides a viewpoint and notes that government assistance programs are actually an economically relevant, I guess, characteristic which will impact the arm's length return, which would be achieved through a transactional net margin method. And so the first chapter of the guidance is in relation to the impact of government assistance programs. On the next point and on the next slide, this deals with the frequently asked questions on the comparability analysis. And so there are difficulties of performing economic analyses, particularly in the situation where there has been a very significant impact on the profit, and which is going to impact the profit ranges that and some of the issues as well in terms of the timing, because the 2020 financial data will not be available yet in terms of actually benchmarking the financial year 2020 performance in terms of the requirements of where companies need to be within the range. And so that's quite a significant practical difficulty in performing benchmarking studies for 2020, given that available data relies on pre-COVID-19 periods, not reflecting the effect of the crisis yet. And respondents and the input that we receive from members and also business as well as we develop the guidelines suggested a variety of ways to address these challenges, including making comparability adjustments, looking to data from previous financial crises, looking for alternate comparables, or benchmarking returns at the lower end of the range as well. And so the guidance does focus on possible practical solutions which delay an analysis of using 2020 data, re-emphasizes relevant sections of the TPG guidelines, such as the use of loss-making comparables, which sometimes are actually taken out, for example, or the use of full ranges. So typically the ranges we would use would be the lower quartile, the median, and the upper quartile range to set the arm's length return. But in this case, perhaps even using the full ranges, such as the minimum identified and the maximum identified ranges. And also identifying data sources that could be considered when performing an analysis as well, outside of the typical databases that are used. We could turn to the next slide, please. The treatment of losses was also a particular area of concern for members and also for businesses as well. And so, for example, one of the areas which was there have been concerns around is the treatment. What happens to the treatment for limited risk entities, for example? And many businesses questioned what remuneration limited risk entities such as distributors and service providers and manufacturers should receive in the current climate, and if such entities could participate in overall losses in the supply chain. And so this is the point that with limited risk, this does not necessarily mean no risk. And this is a reoccurring statement through the discussions as well. And also the treatment of extraordinary costs relating to COVID-19 and businesses that have incurred significant unanticipated costs on personal protective equipment, for example, site modifications, closing and reopening facilities, and are unsure who should bear these costs. And so the guidance sort of took readers back to the transfer pricing guidelines and noted that risk control frameworks will be important when allocating costs, identifying parties that have actually assumed the risks. Allocation of losses to limited risk entities was a key question, as mentioned, and noting that even if you had, for example, intercompany agreements in place which actually noted which entity should bear that risk, the actual risk decision making might have changed through COVID. And so going back to delineation and actually who actually made the decision at the time, as opposed to just looking at the intercompany agreements, was an important point as well. And then lastly, from me on the next slide, the fourth area which came up was the treatment of advanced pricing agreements. And so the businesses noted that in many cases, APA agreements included clauses relating to critical assumptions that would be breached during the pandemic, but questioned whether APAs without these clauses could be deviated from. And there were concerns that different tax administrations may take different views on the applicability of bilateral APAs as well. And so the overall guidance provided in the lighter bluer box on the slide was to really note that there should be a flexible approach to revisiting APAs and revising APAs. And if a critical assumption is breached, then it should not necessarily mean that you immediately do not, that APA will collapse or be breached. And so it was also discussed that early discussions should occur with authorities if you were aware of a breach, so that you could then renegotiate with the authority or agree to continue with that APA as well. And obviously the documentation of that is very important. I think I would just lastly note before I can finish my section is this guidance is not intended to modify the existing transfer pricing guidelines, but reflects on the appropriate chapters and describes how its provisions can be applied. So it's practical guidance on frequently asked questions, but it does not form actually part of the transfer pricing guidelines. I would also note as well that we've received positive feedback from Working Party 6 and the FTA MAP Forum delegates to initiate a knowledge sharing platform where also countries can share what they're actually doing, how they're implementing, and the issues that they're also coming across and dealing with practically as well. So with that, I'll turn to the next speaker. I thank the panel for the opportunity to provide an outline of what the OECD has been doing recently, and now turn to Demis, who'll take us further into transfer pricing developments in Cyprus. Thank you.
Thank you very much indeed, Matt, for sharing this useful information with us. Okay. Thank you, everyone. Thank you for having me. I will speak about a short topic, but in my view is quite important. I will speak about, next slide, please. I will speak first. We know that there is this transfer pricing rules. What is the legal base? Where do we find it? Obviously, we find it in the income tax legislation. That's where you can find it. A bit of the history of that. That appeared only in 2002 in the Cypriot income tax legislation, almost 60 years after the first income tax that we had in Cyprus in 1941. Okay, this section 33 in Cyprus is telling us about the arm's length principle. Now the question is, where this came from, the arm's length principle? It's a long history behind that three words, which started from the US in the 1920s, then moved to the League of Nations, and then from there to the OECD treaty model, and then spread to many countries. I think Cyprus is one of the countries in Europe, maybe the only one that we don't have detailed transfer pricing legislation. Okay, when we read section 33, it gives us this notion about independent prices. So we need to go and find what independent guys would have done if they were not in the same group. We don't have any detailed rules in Cyprus legislation about the comparability, how you do it, or the methods. So the legislation from 2002 until even today sat there without any information or changes. Next slide, please. Okay, the first change came in 2017 that the tax authorities, not the legislative, the tax authorities issue a circular, whereas they provide only on the back-to-back scenarios detailed transfer pricing requirements. So this is just for pure back-to-back activities, and here they provide some information how you should be considered as a financing company. You are not considered a financing company anymore in Cyprus if you don't follow this circular, and mainly this took, you have to have two things. Firstly is to be able to control substance of the entity, to have adequate substance, but also to have the financial capacity. Next slide, please. And now moving to the future, the intention is that we will have detailed transfer pricing guidelines this year, passed from the Parliament. These rules, we are expecting them to be in line with the OECD transfer pricing guidelines. So we expect that the legislation as such to say that this legislation should be interpreted with the transfer pricing guidelines as amended. And the tax circular that I discussed before, we expect that has to be repealed. Thank you. That's from my side. Short, but I think important topic. I will pass it to Costa Sava to continue.
Thank you, Demis. Thank you, everybody, for attending. As Demis mentioned in his presentation, Cyprus will introduce a detailed transfer pricing law very soon, which will be implicitly referred to the OECD guidelines. Concerning now the financial transactions, the OECD last year released this guidance on the transfer pricing aspects of financial transactions. Obviously, those, as Matt mentioned in his presentation, those guidelines are not formed part of the OECD guidelines, but nevertheless, most of the sections are already included in the guidelines. Therefore, we are going to discuss how you are pricing the control financial transactions based on the approach suggested by the guidelines. As I said, we are going to have a legislation soon which will be referred to these guidelines. Financial transactions are very, very important for Cyprus, as we already know, because Cyprus is a financial hub for many multinational entities, and they use Cyprus for their financial activities. Before we get into the different approaches suggested by the guidelines, we should go through very quickly some general considerations included in the guidelines. Matt already mentioned someone, but allow me to go again very quickly, some of them. First of all, both the lenders and borrowers' perspective should be taken into account. A thorough credit assessment of the potential borrower, including analysis, should be performed. Credit worthiness, credit risk, and economic circumstances are relevant. And final, we need to consider whether the group credit rating should be used and as a starting point, and then make necessary adjustments to determine the subsidiary's credit rating, or we should go directly to the subsidiary's credit rating. Next slide, please. The guidelines are suggesting different approaches to pricing intra-group. I should go very quick on this because I just put them there in order for you, when you will get the slides, to have the chance to review them. So I will go through very quick, and then we will discuss one of the approaches that we consider that is the most appropriate in our case in Cyprus. Next slide, please. So we have, first of all, we have the CAP method, the comparable control price method, which is the preferred methodology, as we already know. Next slide, please. Loan fees and charges. In many occasions, when we see independent with third-party loans, we see some arrangement fees or commitment fees to be charged. So when we evaluate the related party transactions, obviously the guidelines they suggesting to take into consideration those fees or commitment fees. Next slide, please. Cost of funds method, which is the one that we are going to analyze in our next slides. So I will leave it after to discuss it further. Next slides, please. We have another approaches suggested by the guidelines is the credit default swaps and economic models. And finally, bank opinions, which obviously the bank opinions are disregarded because they are not considered as an actual transaction. 2-3 slides ahead, please. Here. Okay. Now let's move to the practical approach of the guidelines, and let's see together a very common structuring on financial entities in Cyprus. So this is an example of back-to-back arrangement where the Cyprus company receives loans from its holding company and grants loans to the operating company, which might be based in the UK, Russia, or the US, or wherever, to invest in real estate funds. In practice, of course, those groups are much more complicated. Some of them, they involve many other companies. Some of these companies, they have convertible loans, and obviously many other activities are also included in the balance sheet of those companies. Now, if we say how we will approach this, we have a very practical example, because in the Netherlands and Luxembourg, where they are also financial hubs, for many years now, they apply the cost fund method, which is the most preferable on back-to-back arrangements. More specific, they apply the expected loss approach, which this approach is based on guidance coming from the Basel Committee on Banking Supervision, which this guidance they provide that, and they suggesting that for back-to-back arrangements, the expected loss methodology is the most appropriate. In Cyprus, our practice, and I think most of our colleagues' practice, is that a lot of most of the financial entities at the moment realizing handling fee for the functions performed. Obviously, this is not the right approach because we are going to deal with beneficial ownership issues in the future. So I think this will be, as Demis said, new legislation will come into force. The relevant circular will be abolished. So we need to move on and perform pricing the intra-group loans. Next slide, please. Now, from a purely financial transaction point of view, we need to determine the arm's length principle rates, which in essence, the arm's length principle asks for a credibility of the transaction if it occurs, in a third-party situation. This credibility includes the market rate interest or the risk of remuneration, as we call it in the transfer pricing analysis. And obviously, we need to identify the group financial capacity to assume the loan's credit risk, and on this risk, we need to calculate the relevant remuneration. Now, to determine the equity at risk, we need, as we mentioned already, we need to apply the expected loss formula. Obviously, there is not a magic formula that applies, it's numbers that we put in every case all the time. It's a case by case that we need to consider it, and therefore we have to consider the credit worthiness of the borrower and the risk profile of the industry sector that the borrower is involved. After we determine the amount of equity at risk, which, as I said, the amount of equity at risk is the amount of capital that we need to put aside in order to assume the risk from the lending. So it's an accurate number. It's not a rate. It's an accurate number, which, as I said, it needs to be held aside to assume all the risk. After we determine the amount of equity that we need to keep aside, we need to apply the expected return on this amount, and we applied several economic models like CAPM. Therefore, we are coming and we are pricing the intra-group loans through this methodology. Next slide, please. Now, just to elaborate a little bit on this approach, there are 3 risk factors that are relevant in analyzing the expected loss. This is the probability of default, the exposure of the default, and the loss given default. Next slide, please. So as a formula, we calculate expected loss as follows. Expected loss is equals with the probability of default multiplied by loss given default multiplied by exposure at default. Next slide, please. In simpler terms, probability of default is based on the credit rating grade of the borrower, the credit scoring. Loss given default is the fraction of the outstanding loan that is lost if the borrower defaults. and exposure at default is the loan amount outstanding at the time of default. So this is the three risk factors that determine our formula. Next slide, please. Lastly, from my side, I need to go once again and mention that when we assess the back-to-back arrangements, obviously we need to go and check the agreements and the balance sheet of the borrower. So we have to check some characteristics of the loan, such as the amount, the interest rate, the starting date, the maturity, type of loan, the purpose, conversion, currency, guarantees. We need to check also the interest payment frequency, or if there are any particular payment options. For example, in many loan agreements, we see a term that gives the lender the right to demand its money at any time, which obviously this minimizes the risk. We need to see if there are any security, collateral, and obviously the seniority and payment rank. This is the obvious characteristics of a loan. Obviously, we need to see in some occasions the substance of a form of a loan, but because even if there is no something in written, reading the characteristics of the loan and the terms of the loan, we can clarify and identify that clearly there are more in the loans. So this is from my side. I will pass now the speak to my colleague Christos for the importance of transfer pricing substance.
Sorry. Many thanks, Kostas, for the interesting presentation. Good afternoon from myself. Next slide, please. So my topic is about substance. I'm quite sure that the majority of you already heard and know this word. Substance is quite important, and the reason that is quite important is because if you want to ask me one question and explain me with 2 words the whole BEPS project, I will say 2/3 of the BEPS project is about substance and 1/3 is about transparency. So you understand that substance is quite important. I will say the most important part of the BEPS project. However, we have one huge problem with the word substance. It is not legally defined either in the BEPS project or in the tax law. So what we are doing with our clients in practice in order to provide them with the substance criteria is that we investigate each OECD BEPS project action plan, and depending on the transaction, we advise on that specific topic about substance. Now, in terms of substance in transfer pricing, because as you already understand, different substance criteria will be considered for corporate residents or for beneficial ownership provisions, or under BEPS 5, which is harmful tax regimes under the Nexus approach. Different criteria will be considered when it comes to transfer pricing, although some of them they overlap, but I would say transfer pricing is quite different and quite an overview. So in terms of transfer pricing, it's a certain combination on function, asset, and risk. However, because it's a huge discussion, how you determine that, I will say it's all about people. So it's all about people performing functions, it's about people creating the intangibles or the assets, and it's about people manage those risks. So the heart of substance is about people and function, asset, and risk in terms of transfer pricing. Now, to get more practical about the theory, is that tax authorities in practice, they tend to look for what is the business reality of this company and what is the value chain of the company. And when you analyze that, they tend to look what are the key people functions of that company when they're actually in their value chain and in their business reality. Next slide, please. Now, what has changed effectively in the post-BEPS work in transfer pricing is that we begin with the delineation of transaction. And what do we mean by that, and what is a big change? In the previous transfer pricing guidelines in 2010, those guidelines were very, I will say, focusing on the contracts. So you identify the contracts, and there are only two exceptions. The one exception is that whether the economic substance differs from the actual form. Now, in the 2017 transfer pricing guideline, the exception of the 2010 transfer pricing guideline becomes the norm. And what do we mean about that? We need to delineate the transaction. And what is delineation of the transaction? For each transaction, we begin with the contracts, which is the form, and then we go and see the economic substance of the transaction, and we do see whether the substance follows the form. If this is the case, then we move on. So the big difference of the new transfer pricing guidelines is that the exception of previously used in the 2010 version is now becoming the norm. The next big thing now is that when you delineate the transaction, the risk becomes a king. So when you actually find the key people functions, you actually see what those people are doing and whether they assume such risk, then you remunerate those risks. If the risks of that company are not controlled by those key people, then effectively the company is not remunerated, or it is remunerated by a risk-free return. So in the new transfer pricing guidelines, although previously we had three elements to consider, which is function, asset, and risk, now we see that the risk is the king and everything else is more or less a risk-free rate of return. Now, the next issue is non-recognition. Non-recognition is still the same as the previous transfer pricing guidelines. Now, previously we had two exceptions. Now we have just one. And this exception is that if in your commercial activities, those commercial activities viewed in their totality differ from those that two independent parties will enter into, then the tax authorities are in the position to non-recognize or disregard the transaction. So effectively, in the new era of 2010 and 2017 transfer pricing guidelines, economic substance and controlling the risk is considering the heart of the transfer pricing guidelines. This is something that we are going to see on the next slides. However, let me point out another couple of issues here. It's about group synergies. Now that OECD transfer pricing guidelines, they understand that there are group synergies. So if I may give you an example, is that imagine that you have a central procurement center and you are doing cash pooling from all of your entities. This means that you need to allocate a benefit for the volume discounts, let's say, that you might be getting, or from the savings that you are going to have for each, from your cash pool leader to each cash pool entity. Of course, location savings is something that you need to consider as well. Next slide, please. Now, to get more practical about risk allocation, because as I mentioned before that in the new era of the transfer pricing, risk is a king. On your left-hand side, you see that the function analysis about function, asset, and risk. I have highlighted risk because risk is, I will say, the most important part of your function analysis. And now what is new in the transfer pricing guidelines is about the new 6-step process that we are effectively following in order to identify those risks. So we always start from identifying the significant economic risk, not all risk, but those that are significant economically for the company. Of course, we start from the contracts, we do our factual analysis, and if we do not assume those risks, the step 4, you need to go back. Now, when we identify the risk, the most important part lies on step 5. On step 5, effectively, you need to do, in order to remunerate the risk, and this is an important part, and I want to highlight this, is that in order to get remunerated your entity, you need to do 2 things. First, you need to manage that risk, and secondly, you need to have the financial capacity to assume that risk in case that the risk materializes. So, for example, let's say you have a back-to-back arrangement and you have a loan with different currencies. This means that you assume a risk, which is the foreign exchange risk. However, in order to be able to manage that risk, you need to have internally people, as Kostas mentioned, to make the hedging of those risks. If you don't have the people in order to control that risk, it means that you effectively are not controlling that risk. And secondly, you need to have the adequate equity. This means that the financial capacity, if the risk of that hedging materializes, to be able to be in a position to have the liquidity of the company in order to pay the risk. Now, the important part of management of the risk lies between control and mitigation. This is an important part here because the OECD guidelines effectively says that the people that are controlling the risk needs to be in your entity, but you have a leeway here is that risk mitigation, the day-to-day risk mitigation, can be outsourced to other independent or related parties. However, in order for you to be remunerated on that part, you need to be in the position to control the risk mitigation function. So you can outsource your risk mitigation function, but still the people that are controlling that risk, they need to be in a position to monitor and supervise the people that are mitigating and doing the day-to-day risk. Moving on to the next slide, please. We have a practical 6-step analysis here of how we identify whether a company actually controls or mitigates or has its financial capacity to assume the risk. So as you will see, I have highlighted the word employees. This is what is mentioned in the OECD transfer pricing guidelines because I want to highlight this again. It's all about people. It's not about assets. It's not about functions. It's all about people. So you need to have people, employees, to be in a position to make decisions, take on or lay off, decide in order to take a risk. So this is the first question. If the answer to that is yes, then you need to move on to the second box, where that employee on their day-to-day work and their ongoing business are able to supervise those risks already controlled as mentioned in step 1. But in any case, even these 2 boxes fail, you need to go back to step 4. Now, if those employees are effectively assuming the risk and controlling the risk on their ongoing decision making, then you need to consider whether those employees actually mitigate that risk and they are running up their risk outcomes. If you can see that, if the answer is yes, this means that you're already doing your risk mitigation. If the answer is no, however, we go on the bottom right-hand side, where is the risk mitigation outsourced? If the answer to that is no, then you go to step 4 again. But if you effectively outsource the risk mitigation function, then effectively you need to be able to control the risk mitigation function. If you do these activities all together, you tick the box that you control the risk, and then the last part is whether you have the financial capacity to assume the risk. If you have both, as we mentioned in the previous slide, then you are fully remunerated as a proper company for transfer pricing aspect. In case you lack of substance somewhere, it means that your remuneration will be reduced and no more profits will be allocated to you depending on the activities that you are outsourcing. Next slide, please, to see a practical example. I'm quite sure that you are going to ask me how you do that and what is your daily work. So in practice, we have different levels of people taking decisions, and those different levels count differently when you are remunerated in terms of substance. So the first level, the first tier one, it's the people that they are doing the oversight. So if you have a big M&E, you will have a board, the CEO, the CFO, the C-suite type of people that they are doing the governance of the company and they are oversighting the business. Those people that take the very high level decisions, actually in huge M&Es, they don't have a direct responsibility. And in this respect, the remuneration in terms of transfer pricing is not that high. So let me repeat about that. Huge M&Es, the CEO and CFOs effectively, you don't remunerate that much. However, if you go down further to the second tier, where the head of such divisions, those head of divisions are the actual middle managers or the head of those divisions that they are actually controlling the risk. Those are the people that they take the risk on their day-to-day basis, and those are the people that they are actually remunerated the higher in terms of transfer pricing. Let me point out a practical example here is that if an M&E, the smaller the M&E is, the higher you remunerate the CEO and CFO because tier 1 and tier 2, they come together. But the bigger the M&E is, let's say Google, Amazon, and so on, the less you remunerate CEO and CFOs. So in practice, we've seen that these huge M&Es, in order to solve their problem, post-BEPS, they transfer a lot of middle managers in, let's say, Bermuda, and they solve their problem. Now, going down to the third level, which is the managers and those people that they report to the controllers of the risk. These are again, they are key people. They are doing the day-to-day risk, which is the head of sales subdivision, the head of team, sales managers, and so on. These people report to the head of divisions. So these people, if they follow the instructions of the head of divisions, they will be remunerated as well. So these people are also important when we remunerate the transfer pricing, but still we need to consider to whom they report and how they are doing their day-to-day work and where they are. Finally, the last part, the fourth tier of the hierarchy of a big M&E, it will be the support and routine implementation function, which is the operational level. Here, where the operational level is, this is the risk-free, I would say, activities. We don't remunerate much these activities because it's more operational than assuming or controlling the risk. And I will say in this four-tier section, I will also add the experts. Let's say you want a tax advice, you want a legal advice, you want to outsource your HR. Again, the experts that you outsource services, effectively, you don't remunerate them a lot. So this is what happens in practice. We effectively are moving out from the contracts. Okay, you start from the contracts, but effectively you dive into the value chain of the company, you dive into the business activities, you scrutinize who is doing what, depending on their activities, you look at who is controlling the risk, and you remunerate each person depending on that specific part. Moving on to the next slide. The same six-step framework is also similar to the intangibles. Someone may ask me why you are the OECD transfer pricing guidelines, they have a separate chapter for intangibles. The reason is quite simple, because today intangibles are very important. If you look at the Fortune big companies, previously there were companies with huge assets. Now there are companies with huge intangibles. Have a look of Amazon, Google, Facebook, and so on. They are all full up of high-value intangibles. So they have a specific 6-step framework for intangibles. The principles of the 6-step framework is quite similar with the one shown before, which lies on the chapter 1 of the transfer pricing guidelines. But I would like to highlight the point here is that here you remunerate, okay, here you begin by identifying the significant intangibles of the firm. And you remunerate those activities based on the DEMPE function. So the DEMPE functions are those key important activities that you are going to remunerate. The issue here with the intangibles is that the legal owner of the intangible is not remunerated. Let me rephrase it because this is not correct or fully correct. The legal owner of the intangible only gets a free risk remuneration. Who is remunerated for them in terms of transfer pricing is those key people functions that they are doing the DEMPE activities, assuming the risk of the DEMPE activities, which is the economic owner. So if you have a back-to-back loan and effectively, a back-to-back licensing, and the legal owner just receive a royalty-free rate, even if you don't receive a royalty-free rate, for transfer pricing purposes, you are going to receive a risk-free rate of return. All the other steps are quite similar, so I don't want to take your time discussing the other steps. Next slide, please. And let me continue to the questions and answers. Here my colleague Christodoulos will follow up and make the roundtable discussion in terms of the Q&A. Thank you very much.
Christos, thank you very much. Thank you all the speakers for their presentations. And we will now move to the Q&A session. I note with pleasure that there are numerous questions in the box here in front of me. I would like to excuse the persons who posted the questions. I will start with the last one because it's very relevant to the last presentation of Christos. Christos, the question is, what do you mean when we say remuneration of the key people?
Yeah, so let's assume like you have an IP asset, that this IP asset is legally owned by an entity. Let's assume this entity is based in Cyprus and receives millions of royalties. However, all the DEMPE function, I mean the development, enhancement, protection, maintenance, and so forth, is actually run by other entities of the group, which those entities are not in Cyprus. So those entities are effectively assuming the risk, and they have the financial capacity to assume that risk. This means that because the Cyprus entity does not control any of those risks, and all the key people that they are developing, enhancing, and doing the IP management, protection, and so on, are in other jurisdictions, effectively the income of those, the income of that company will be shifted to those entities, and the Cypriot IP holding company, which is the legal owner, will only remunerate it by a risk-free rate for that IP asset that it holds, which is the legal owner, and all the other economic owners will be allocated the profits in that country. So in practice, what will happen, the other countries will increase their profits in their tax base, and then you need to, by Article 9.1 of our tax treaty, which allows them to make them primary adjustment, and then here you need to do the secondary adjustment change the tax base of the Cypriot entity.
Just if I may add here, yeah, and we have also Matt as well. Maybe he would like to comment on this. I think what is very important to explain is that this transfer pricing that we know today is here for almost 100 years. In order to be able to cope with current way of business, had to evolve. Otherwise, there were many advising, planning on transfer pricing, for example, moving your operations there and here without people. So what they did now in 2017, they gave much emphasis, the OECD, on the people. So the transfer pricing started with pure economic principles. These functions, asset, risk come from the economic theory, but then we moved a bit, or we elaborate the standard, and now they are looking where are the people that deciding for the assets. So where are the people? That means the place that these people are located. That means that country is the country that should get the income among the MNEs. So it's not who owns the assets, it's more who decide for those assets. I don't know, Matt, if you would like to comment.
Yeah, only to sort of say, and I think Kostas has explained it very, very well. But the key point has been in the past. If you think back to BEPS and why value creation came in and substance came in, it really was to stop tax havens by using zero people, but moving most of the profit into a location. And so Christos is right, which is you're looking at not the board level people or oversight people. You're really looking at the people actually making the decisions. And the way I've done it in my career is to use what's been referred as to the RACI, who is responsible for that particular function and who is accountable for making that decision, which is the two layers that Christos mentioned. And it's getting those people who are actually managing and driving and mitigating the risk has meant that the zero people havens are now starting to disappear in terms of not having any people related to managing those risks. And when we say management, it's exactly as Christos has mentioned. It's the actual management of that risk and making sure that it aligns with the actual with the agreement. And where we have a disagreement where the contract says this is the entity getting the risk, taking the risk, but the people are actually in another jurisdiction, it's the people that will attract the profit. And that's what's important. And that's why it was put in place in 2017.
Yeah. And to add to your opinion, Matt, on this and to illustrate the difference of substance, and what Matt just mentioned in Cyprus is that the corporate residency criteria of Cyprus is all we know, it's management and control. And because we're a common law jurisdiction, the substance criteria for corporate residence is to see the top tier high level of decision, which is the CEO, CFO, and so on. However, for transfer pricing, we go one or two levels lower on that in order to remunerate. So here you see the difference between corporate substance criteria and transfer pricing substance criteria. They kind of overlap, but you are looking for different level of peoples and different level of decision making.
Thank you, gentlemen. Thank you for your answers. Let me go straight to the next one because we have numerous questions and only 8 minutes to go. So the next one, I'm reading. We have seen many cases where the CUP method is used for TP purposes for financing arrangements. However, no comparable can be identified. For example, no Russian ruble comparable exists, and professionals are using other conditions, i.e. euros to dollars, etc., Is such a policy acceptable from a transfer pricing point of view? Who wants to take that?
I will take this, and I think Matt should also add. Now, in my practice, it's not very common and it's very unusual to not find the comparables that you are looking. Nevertheless, if you follow the guidelines, there are some ways to overcome this. Obviously, one of the ways is to perform the relevant adjustments in order to bring the results to the closest comparable as possible. And another method that Matt mentioned in his presentation is to use a full range instead of an interquartile range in order to minimize your exposure and the risk this to not be comparable.
Yeah, and I would just reiterate that. Sorry, and just sort of say I agree. It's unusual not to find the sort of currency transaction, and if you can't find it, then adjustments or use of the full range is typically how we manage that. But it becomes challenging because it's currency, as mentioned by Kostas, is a critical comparability factor. So I think that would be worth exploring where you can find those transactions.
Thank you, Matt. Reading the next one, guys. Is it obligatory to be a financing company in order to provide a loan to a company? I am referring to the back-to-back loans. Are these loans considered to be passive income or business income?
Okay, let me take this, if it's okay, from my colleagues. Okay, thank you. All right, first thing come first. All right, reading the question. Okay, here is a good question. Okay, first we need to decide whether it's a business income or a passive income. We need to decide from a Cypriot perspective, and I will agree that maybe this can be considered as a business income because this is your trade. However, this is not that important because when we're talking about serious structures between countries, then the treaty law applies. So the treaty in the Constitution of Cyprus is above the Cypriot legislation. So the treaty, it will tell you whether it's a passive or it's an active business income. And the treaty is telling you if, for example, you have a loan and then you have these two options, whether you consider it as a loan or as a business income at the treaty level, then the treaty tells you that you should consider that this is a loan. So if the treaty said that this is a loan, then the whole thing is a loan. So this is a very key question. We identify that this structure, the characterization of the income is loan. What do we do next? Then we know that the circular that we have, and this is unnoticed for many people in Cyprus, is telling you that in order to be a financing company, I want you to have substance. Let's leave this aside for a moment. But the most important, to have capital. Enough capital, and we don't see many companies to have the enough capital. So that means the Cypriot tax authorities is telling us if you are a pure back-to-back, one loan in, one loan out, for example, from the Cypriot tax authorities, you are not a financing company. That means if the treaty partner comes and asks the Cypriot tax authorities, is this company a financing company under your rules? The Cypriot tax authorities will say no because they don't have capital. There are many ramifications if you are not a financing company. For example, the other country, Russia, England, US, will deny you the expense, will maybe put you with quality tax, and etc. So that's my answer. You're muted. Christodoulos, you're muted.
Excuse me. Thank you, Demi. I'm going straight to the next one. 90% of the Cypriot financing companies do not meet the conditions of circular number 3, nor meet any substance requirements, as the only director is Mrs. Marula, which is also a director in another 500 companies. Do we have any guidance how the new transfer pricing regulations will be imposed on such companies? Please answer it as quickly as possible because we have one more in only 3 minutes.
Okay, allow me guys to go through very quickly on this. It's a very, very good question because it's actually applying what we have mentioned in our presentation. The guidelines, they say that you need to see not only the borrower in order to pricing an arm's length rate, but you need to see the lender as well. Obviously, it's good to know that the companies, they don't have any substance, or the directors are directors in many companies. But when the time comes and you need to apply and you need to pricing the intra-group loans, you need to keep into mind the facts and circumstances that the questions has asked to us.
Costa, thank you. Regarding intra-group loans back-to-back that will fall below the new law thresholds, and considering you mentioned the circular will be cancelled, what will be the requirements for such entities?
Let me take that because I think I covered in my slides. Yes, we don't know what the law will actually say, but we know that probably this circular will be cancelled. So what will remain? Will remain that if you are falling under the threshold, then you have to apply transfer pricing guidelines, TPG guidelines. The transfer pricing guidelines, as discussed today, they are bringing these two conditions, the substance and the requirement for capital. So if you are in this threshold, you have to meet these two conditions. If you are on this or not on these thresholds, then other methods can be used.
The issue, if I may add on this point, guys, is that if you overcome the threshold, then effectively what then is mentioned to illustrate the point, you need to make a transfer pricing documentation and support your arm's length principle. This effectively actually is on the benefit of the taxpayer because you are shifting the burden of proof from the taxpayer to the tax authorities. So if you have transfer pricing documentation, it means now it's on the turn of the tax authorities to investigate your transfer pricing documentation and support their view. However, if you don't make a transfer pricing documentation because you are not picked up by the threshold, so you are below the threshold, it means that if you are using a specific rate and this rate is not supported by a transfer pricing study, it means that the tax authorities, they will adjust your profits according to their reasoning, and then the burden of proof lies on the taxpayer to verify the rate used. So in a perfect world, the taxpayers will provide tax certainty by doing a transfer pricing study in order to shift the burden from the taxpayer to the tax authorities. Of course, here you need to weigh what is the cost of doing a transfer pricing study and what is your tax risk, but you understand that in high amounts, a transfer pricing study will safeguard the client.
Thank you, Christo. And now to wrap up, guys, thank you very, very much for your participation, your questions. I know some left unanswered. You can email them to us. Can I have the next slide, please? I would like to thank everyone who was in the session today. I hope you have enjoyed our presentations. Once again, thank you to Matt, who is taking the time now to discuss our subject today. Right now, where he is, it's 3 a.m. that he is actually with us. So, thank you again, Matt. As a reminder, our speaker profiles are right now on the slide, and you can even email us for any other questions that you may have. Can I have the next slide? Taxand Cyprus is right now the most experienced transfer pricing firm in Cyprus and the most sophisticated one. Remember to stay tuned because the new TP law is coming in, and we will be here to update you once again on this new legislation. Enjoy the rest of your day wherever you are in the world. See you soon. Bye.